What if I told you that one of the biggest players in the global financial system may be quietly stepping away from US Treasuries, and almost nobody's talking about what that really means? Not in headlines, not on mainstream TV, and definitely not in a way that explains why silver and gold have suddenly started acting differently. This isn't noise. This isn't speculation for clicks. This is about capital flows, power shifts, and why precious metals may be setting up for a move that catches most people on the wrong side. If you hold dollars, bonds, silver, or gold, or if you're planning your next move, what you're about to hear could completely change how you see the market right now. Before we go any further, if you value calm, clear breakdowns of what's happening behind the scenes in silver, gold, and the macro system, take 1 second to like this video and subscribe to Silver Shockwave. It helps the channel massively, and it keeps you plugged into moves most people only understand after it's too late. Now let's slow this down and walk through what's really happening, because the story isn't China dumps treasuries and metals go up. That's the lazy version. The real story is much deeper, and it explains why silver and gold often move before the headlines, not after. For decades, US Treasuries have been the backbone of the global financial system. They're supposed to be safe, liquid, boring, and predictable. Countries park reserves there. Institutions hide there during uncertainty. The entire system assumes treasuries are always there, always trusted, always wanted. But that assumption is starting to crack, and China sits right at the center of that crack. Over the past few years, China has been steadily reducing its exposure to US Treasuries. Not all at once, not in a dramatic crash that would spook markets overnight, slowly, methodically, quietly. This is important because smart money never moves in a straight line when the stakes are this high. When a country with trillions in reserves adjusts its strategy, it does so in a way that doesn't blow up its own position. The key question isn't whether China is selling treasuries. The data already shows a long-term decline. The real question is why and where that capital goes instead. Because money doesn't disappear, it rotates. Part of the answer is geopolitical risk. When reserves can be frozen, sanctioned, or politicized, holding too much paper tied to another government becomes a strategic weakness. Another part is math. Rising debt, rising deficits, and rising interest costs make long-term confidence harder to justify. And then there's the currency side. If you're worried about long-term dollar purchasing power, holding long-dated debt denominated in that same currency becomes less attractive. Now here's where silver and gold quietly enter the picture. When large holders reduce exposure to treasuries, they don't just move into cash and sit there. Cash is a temporary parking spot, not a strategy. Over time, capital looks for assets that are neutral, liquid, and outside political control. Historically, that role has belonged to gold. And increasingly, silver is being pulled into that conversation, not just as money, but as a strategic industrial metal. Gold tends to move first because it's the obvious reserve asset. Central banks buy gold openly, they report it, they talk about it. Silver is different. Silver moves through tighter markets, thinner liquidity, and far less attention. That's why when silver moves, it doesn't walk, it snaps. This is why you often see a pattern where gold starts to grind higher quietly, volatility stays low, and then silver suddenly wakes up and shocks people. By the time social media notices, the easy part of the move is already gone. Another layer most people miss is what happens to yields. When large buyers step back from treasuries, yields tend to rise unless something fills the gap. Rising yields increase stress across the system. They pressure stocks, real estate, and governments themselves. That stress feeds demand for hard assets, even if the price action lags at first. Silver, in particular, sits at a strange intersection. It's monetary when confidence breaks. It's industrial when growth narratives return. And it's brutally volatile when liquidity tightens. That combination is dangerous for anyone who assumes silver behaves like a calm, predictable commodity. It doesn't. It behaves like a pressure valve. And here's where the playbook really matters. When capital rotates out of treasuries, it doesn't immediately chase silver futures or ETFs. First, it hedges. Then it diversifies. Then it looks for assets with asymmetric upside. That's usually when gold establishes a base, volatility compresses, and sentiment stays bored. Silver lags just enough to frustrate bulls and convince bears they're right. Then something breaks. It could be a bond auction that struggles, a funding market that tightens, a geopolitical shock, or simply a realization that the system is more fragile than pricing suggests. When that happens, silver doesn't politely reprice. It gaps. Liquidity thins, shorts scramble, and retail shows up late, chasing green candles. That's why timing matters more than predictions. You don't need to guess the exact day China sells another batch of treasuries. You need to understand the direction of pressure. Slow structural shifts create fast market reactions. Another important detail is that silver supply isn't flexible. You can't flip a switch and mine more silver overnight. Much of silver comes as a byproduct of other mining operations. That means when demand rises unexpectedly, the market doesn't smoothly adjust. It tightens. And tight markets with rising investment interest don't move gently. For gold, the story is stability and trust erosion. For silver, the story is leverage and shock. That's why silver often underperforms, right up until it wildly outperforms. If you've been watching Silver Shockwave for a while, you know this channel isn't about hype. It's about recognizing stress before it becomes obvious. And right now, stress is building under the surface of bonds, currencies, and confidence itself. None of this means markets crash tomorrow. That's not how systemic shifts work. They grind, then they slip, then they suddenly move. The people who get hurt are usually the ones who assume nothing is happening because nothing dramatic happened today. As we move closer to the end of this video, here's the most important takeaway. China reducing Treasury exposure isn't a trade. It's a signal that the world is slowly rethinking what safe actually means. And every time that definition changes, gold and silver end up being repriced, not because they changed, but because everything else did. Silver especially doesn't need perfection. It just needs pressure. Pressure in bonds, pressure in currencies, pressure in trust. When those forces align, silver doesn't wait for permission. Now I want to hear from you. Do you think this Treasury shift is overblown? Or do you believe we're still early in a much bigger rotation into hard assets? Drop your thoughts in the comments because I read them and they help shape future videos. And if you found this breakdown useful, share this video with someone who still thinks silver and gold only move on inflation headlines. This is Silver Shockwave, and we'll keep watching the moves most people don't notice until they suddenly matter.